Thank you for attending today. I'm going to let Nate just give you a brief overview of Crosby Advisory Group and a little bit of his bio, and then we'll roll right into the presentation. Just to let you know, we do have a few events coming up. You can always capture our registration and events under the chardonnechamber.com. Under the events tab, if you click on the chamber events, that'll take you to all of our networking information. And then, of course, the members are able to post any special events you have on that calendar. And you could do that through the back end of the website, which is the info hub. So if you log in, you have some kind of, I guess, presentation or another networking event that would be very good for business members to come to. By all means, please put that up there and utilize that to help market those promotions and events. But the next one coming up is February 7th, which is our business after hours, the Collective Rose, which is a boutique right above Antiques on the Square. So that's from 5 to 7. Blue Lake Cleaning is helping sponsor that. And from what I understand, Nate is tapping into his bourbon collection. So you'll be able to shop, you'll be able to network, you'll be able to sample some bourbon. That's a good one to come to. Then our new member event. We are really targeting members that have joined up from 2022 for moving forward to come out to Chardon Performance Therapy on February 13th. That's between 5:30 and 7:30 p.m. These events are complimentary to the chamber members, and we'll have NOAC, the Northern Ohio Area Chambers of Commerce, coming through. So they'll explain some of their cost-saving benefits, but again, networking, beverages, some snacks, and just a good time to meet some new members and get your networking circle going. But please go over to our website and check out all the events that are coming up. And of course, our March 12th awards banquet. That's the big one. That's our big quarterly event for the chamber. So I'll let you guys explore all of that and let Nate take over. So Nate, you have the floor.
Okay. Well, I appreciate everyone allowing me to speak today. Again, my name is Nate Crosby. I'm a managing member at Crosby Advisory Group, LLC. I have Derek Ballinger on the call with me. Derek's going to be helping with the slides as well. As Derek mentioned, he is an analyst for us, also an advisor. Derek is a graduate of Ohio State. He was an economics major. He is currently working to achieve his CFA designation, which is the highest standard you could have, highest designation you could have within the financial industry. So he is a glutton for punishment, but he's the guy that you want in your corner if you are ever in a heated debate about standard deviation. Myself, Nate Crosby here. I live just outside of Chardon. So my 3 daughters go to Chardon. My oldest goes to Chardon High School, and my 2 youngest go to St. Mary's in Chardon there. So very active in the local sports, and we are excited to be more active as new members of the Chardon Chamber of Commerce as well. But this is fitting. What I wanted to talk today about is 7 moves to make in 2024. These are moves that we are doing with our clients, but it's something that I think that everybody, if not all 7, there's something that I think that everybody can probably take from it. And it's also fitting that we're doing it in January because, let's face it, a lot of us on December 31st had looked at the year that was and said, you know what, there's some things that I maybe would like to improve on, whether that was health related or financial related. So here we are in January with a clean slate. The thing that I would recommend anytime, obviously for this presentation, we're going to be talking about financial goals, what we can do financially. But with any goal that you achieve or set out to achieve, the mistake is, the old adage is we make the resolution on January 1st, and then by May, we're back to our old habits, right? And a lot of that is because the resolutions we make, the reason we attach to it, it's not strong enough, right? I want to lose weight doesn't work when it's a Friday night and we're at our friend's house and everybody's eating pizza and drinking. I want to lose weight because I want to be able to walk my daughter down the aisle. That has a much bigger impact to it, right? And so we want to do the same thing with our financial goals. I want to have more money is not going to sustain us when the stock market takes a downturn or the cost of living goes up. We'll have all sorts of excuses why we're not continuing in our accumulation plan. But again, let's attach something greater to that. And in my mind, we need to attach something to it that kind of shakes us to the core. If we think about it long enough, it might even bring tears to our eyes, right? I want to be able to retire at a healthy age so that I can, experience my grandchildren, so I can hold them and play with them, so they can get to know me. that type of a goal is going to sustain us far longer than I just want to have more money. So that would be my first recommendation is when you really look at your plan, ask yourself, why am I doing this? The first, the first move that we would do, and this is a lot of time for newer clients, is we start with the basics. And so the first move for 2024 is to dial in your savings rate. And the reason for that is the component that makes everything else work. Most of us, unless we sell a business, inherit money, win the lottery, most of us are going to accumulate our wealth over many decades, right? And the goal or the engine that makes that work is our savings rate, what we go into there. So the CFP board recommends that our savings rate is anywhere between 11 to 15% of our take home income. As an advisor, I want to help a client err on the high side, right? I want to be more towards that 15% mark. The reason for that is what if our investments over the next 20 years don't perform as well as they had over the past 10? What if the cost of living, as we have seen inflation last year and part of this year, what if the cost of living continues to go up dramatically? What if I begin to lose my health? There's a lot of these what if questions. And a lot of times when you get into planning, some of the reasons that we plan, we can name specific goals like I want to buy a beach house or I want to be able to retire at 62. But a lot of times we're planning and saving just because we don't know what the future holds. And so that 15% savings rate is where ideally we want to get to. And that would be for somebody who is retiring in quotation marks, normal retirement age. I would define normal retirement age as anywhere between 62 and 70. And why is that? That is because that's when most people who pay into it can start claiming a Social Security benefit at that time. So we're supplementing that Social Security benefit with the assets that we've been able to achieve over our retirement span. So a lot of times when I start off with a new client, we'll get the information down. I will look at their savings rate. That's one of the first components I look at. What are you already saving? And I see where they're at, and then we make a goal to get to that 11 to 15% mark. And it's not uncommon for somebody initially in that meeting to look at that and say, Nate, you've lost your mind because everything's going up, the cost of living is going up, and I don't have 15% to set aside for a savings rate. It's not easy. I can tell you it's doable because we do it all the time, right? And within that savings rate is also employer matches, right? So if you are working for a company that has a 3% savings or matching plan on the 401k, well, then now you only have to get to 12%, right? If it's got a 4% match, and I only need to get to 11%. So we're including those matches as part of the savings rate. A couple things, a couple hacks you can do in order to get to that savings rate is keep in mind if I have a client and let's say in the beginning I do the analysis and they're only saving 5% of what they make. That doesn't mean that we stop investing and get to a savings rate before we begin investing again. No, we start right away, right? Because there are three components to accumulating wealth. We've got what we put into the account, we have the return that we get on our investment accounts, and then we've got the time that we allow those investment accounts to grow. So what we add, the return, and the time. Of those three, it's the funding. What we put into our plan is what we can have the most control over. The second would be time. Unfortunately, I can't go back 10 years and say, I wish I would have started earlier, but I can start today, right? I can start today. The old Chinese proverb where the best time to plant a shade tree was 20 years ago, the second best time is today. That holds true with investing for sure. So if I am not at that 15% savings rate, 11 to 15%, that's fine. I'm going to start with what I have. But going forward, I'm going to begin to get to the point where I can get to that 11 to 15% mark. And there's a couple easy ways, not easy as far as following through with it, but easy as far as understanding how to achieve it. The first would be as we progress through our careers, most of us become better at our job, right? The longer we do our job, the better we are. The better we are, the more valuable we are to people. And the more valuable we are to people, the more income we demand, right? So over the course of our career, we tend to have a rising income. So one of the tricks is every time we get a bump in pay, we want to take 50% of that bump and move it over to our savings rate. If I lived over the past 12 months on my old salary, I should be able to live on the next 12 months on my old salary plus half of my bonus. And if it's not 50%, just take as much as you can and move it over to that savings rate. If you do that, within a matter of years, you should be at that 11 to 15% mark. And it's not uncommon to have a client who gets in that habit of saving 50% of their bonuses and they find themselves in a 20% savings rate. So that just puts the odds in your favor if you do that. The second thing that you can do is obviously we can do a spending analysis of where is our dollars going, right? It doesn't matter if we are Warren Buffett or if we're Derek Ballinger. We all have a fixed finite amount of resources, and where those dollars go is incredibly important, especially in your accumulation plan. So, Derek, if people are interested, there's lots of budget apps out there that you can get free. We have an old school one that we can email you. It's a piece of paper that you could print off and fill out. Derek has developed a one that can be found on our website as well. And Derek, is there a link to that that the people can get?
Yeah, we're gonna send out the slide deck to everybody that's on the call, and then we're also gonna put it on our website. All the links that will be relevant are in the the
Okay,
slides.
perfect. So the one that Derek built is it's more interactive. It's online. It's digital, and it provides. Correct me if I'm wrong, Derek. It does provide kind of what if situations where we have different scenarios,
Sure.
and what
Like
you
what
look
if you
at
get
as
a
far as the
raise?
savings
Yeah,
rate.
etc.
Yep, all that stuff. Yep. So I force myself to do a spending analysis of myself every year. I do this for a living. I still have myself do this once a year. The trick is you don't want to do it in December, and you don't want to do it. If you take a family vacation every August, probably don't do it in August. Pick a normal month in order to do that. I can tell you that every time that I do it, there's something that jumps out at me when I look at how I'm purchasing my food, um, my insurance costs, my utility costs. There's always some things that I can manipulate to make my savings rate a little bit better. So that's step one. Move to make in 2024 is begin to dial in your savings rate because that makes everything else happen. Is there any questions on that one? I'll move on to number two. The number two move that we are building in 2024, and this would be for newer clients, would be to build an emergency fund. If I used Warren Buffett as an example. Warren Buffett is widely considered to be the world's greatest investor. He's been doing this for so long. He's seen everything. He's seen rising markets and bear markets, and he is presently worth about 118 billion dollars. That's billion with a B. And he didn't get there by investing in CDs. He didn't get there by stuffing the money under his bed. He got there by buying quality companies, quality investments at a fair price. And he's quoted, one of his famous quotes is, "My favorite holding period is forever," because he wants to buy a quality company and then just let that do the work. And that's how he has accumulated his wealth over decades and decades of sustained, committed investing. And I don't say this because we all need to be Warren Buffett or we need to have Warren Buffett's wealth. Chances are we're not going to have Warren Buffett's wealth. But what we do want to watch is his process, his idea of investing. You know, my moment that stuck with me with Warren Buffett as an investor, as a student of investing, was in 2008. For those you remember, 2008, our Great Recession, the market lost about 49%. From peak to trough, it lost about 49%. And a little more than halfway through that recession, Warren Buffett penned an article in the New York Times. And for anybody who is new to investing, I highly recommend you Google search this because this is the mentality we want as long-term investors. The title of the article is called "Buy American, I Am." And he wrote this, again, not halfway through the recession. And basically in the article, he said, we've got problems. Banks are failing. People are losing their homes. People are losing their jobs. We are in a deep, deep recession with no end in sight. And he said, but you know what I'm doing? I'm buying American companies because I know in the long run, and I don't know when that long run is. I don't know if it's a year or two or 3 years from now. I know in the long run, I'm going to be rewarded for that. And the only way you can do that, right? So I might have a client who fills out a risk questionnaire and they say, Nate, I want an aggressive portfolio because if that happens to me, if my portfolio loses 20%, it's not going to bother me. I'm going to stay invested. I know it'll come back. And that might be true. But what if he's forced to sell? What if I have an investor who's so excited about investing that they've got their 11 to 15% savings rate, and now they're taking every dollar and they're stuffing it into their long-term accounts. Well, on paper, if I'm investing in, let's say, the S&P 500 or the US stock market over a 20-year span, yeah, I should expect that, roughly 10% return in the account. It works every time on paper. The problem is uh, real life doesn't happen on paper, right? In real life, we have the family car and we have the roof spring a leak all in the same month. And if I'm taking every dollar and putting it into my long-term investment accounts, I have to pull it out. And the reason why Warren Buffett is worth 118 billion is he's let that wealth compound for decades and decades. The way that a compound interest curve works, it's those last 10 years that are actually the most crucial because interest is growing on interest and capital gains on capital gains. And we can't get there if we're rating our long-term investment accounts every time something happens in life. So the trick is we need to build to use an analogy, a big, thick offensive line between our investment accounts and everyday life. And that comes in the event, or that comes through an emergency fund. So at Crosby Advisory, we recommend 6 months of income in that emergency account. And that's the first thing that I get is people's eyes get really big and say, Nate, I don't have 6 months of income to give you. So if I made $60,000 a year, I would eventually want an emergency account that is worth $30,000, half of what I make. That doesn't happen automatically. It doesn't happen over time. What we do with our clients is we build that over time. So again, I'm not stopping my long-term investing in order to create my emergency account. I'm building my emergency account with my long-term investing. So our example is, our investor who is able to get to that 15% savings rate. Well, he's not taking all 15% and throwing it in a 401k. He might take 10% and throwing it in long-term investments, and then the other 5 are going towards his emergency account. And then every month goes by, in the beginning, he doesn't have 6 months. He doesn't even have a year. But as the months go on, his plan becomes stronger and stronger and stronger, and he is able to withstand everyday life. So that's the main thing. It protects our long-term accounts from having to be rated for life's unexpected events. The second thing that it does that is huge, and why I introduced Warren Buffett in the beginning, is it allows us to act as long-term investors. If I have 6 months of income eventually over time in my emergency account, I'm not as concerned about the day-to-day price movements in my long-term investment accounts, what my 401k is doing. Because I know if something happens, if I lose my job, if I get sick, if the car breaks down and my roof springs a leak, all in the same month, I have got cash there to do it. I don't have to worry about that. So that is the number 2 thing that we're doing in 2024 is we're continuing to make sure everybody has an emergency account. Build that towards, if I can get 3 months with some people, that's a win. Ultimately, if I'm working with them over a matter of years, I would love for them to get to that 6-month mark because there's not a lot that life can throw at you that you're not able to absorb if you have. Any questions on that? All right, we'll move on to number 3.
Sorry, Nate, did you want to talk about the composition of what an emergency fund would look
Yes,
like?
let's do that. Let's do that. So what Derek has up in front of you is a typical short-term investment strategy. So this would be a short-term investment account. And when I say short-term account, it actually always doesn't have to be in one account. Sometimes it's not. But what we're looking at is if I am able to achieve eventually over time, if I'm able to achieve 6 months of emergency money, I don't necessarily have to have that in my checking account. I don't necessarily have to have that in the savings account that is earning very, very low interest. A lot of times we'll tell clients to take 2 or 3 months and put it in your savings account so that you can get to it. You can walk to your bank and get that if you need it. But the other 3 months, the other 3 to 4 months, we might have that in treasury bills, right? These are also considered cash equivalents. I can sell them at any time because that's the number 1 rule to a short-term allocation is I need to be able to get to them without penalty. This can't be in an IRA. This can't be, I even don't like CDs in these accounts because CDs would have a window of time in which I can access those. So I want treasury bills. I want things that can be liquidated without penalty and I can take them if needed. A money market is also another way to do that. So we have typically some combination of cash in their savings, some form of money market, and then typically treasury bills in some form or fashion. All right, thanks, Derek, for bringing that up. All right, number three, moving along here. I think we want to, in 2024, we are looking at our clients and saying, I think we want to take advantage of these high interest rates for a longer period of time. And what I mean by that is, as a country here, we've had a bit of a perfect storm in the past couple of years. We had COVID. We had a massive amount of stimulus that was printed to help people along. We had supply chain constraints, and people couldn't get the things they needed to run their business, to produce their products. All this drove up the price of everything. If you remember, in July of last year, the inflation rate was above 8%. So that is high, right? That is high. So when inflation gets out of control, like it did, the tool that our central bank does in order to bring that down is it begins raising interest rates. Because when it raises interest rates, it makes the cost of business more expensive. It also is prohibitive to lending. Like if I want to go out and buy a house or get a car or something like that, the cost of me doing that actually increased, right? So I might think twice about doing that. Well, that combination of things, cost of business going up and the ability to get an affordable loan, tends to put a little bit of a governor on the economy. It tends to bring the inflation back down, and that's what we've seen. That's what we've seen since mid 2022. We've seen that begin to kind of steadily come down. Last month it kicked up a little bit, but not too much. So if you remember, the reason for me saying this, you remember when they did this, they would meet, and every couple months they would raise that rate by 0.25%. Why were they doing that? Well, because monetary policy is not an exact science. They would raise a quarter and then wait to see what happened. Raise a quarter, wait to see what happened. Hey, we didn't break it yet. Let's do it another. The opposite happens when there's trouble with the economy. If the economy begins to slow down, they typically don't decrease it by a quarter because that doesn't have the needed effect. They typically drop it by a little bit more than expected, because that stimulates business to get going. That stimulates people to go out and get a loan, get the economy going. And when they met at the end of last year, one of the things that they hinted at was, hey, we could possibly see a 75% rate reduction in 2024. That's not a set thing. We don't know that. A lot of it will determine what inflation does, but it's on the table. It's on the table that we could potentially see a rate reduction. So getting back to our short-term emergency accounts, where we've got our safe assets, money markets have become hugely popular, right? Our money market rates, you can get a money market rate that's over 5%. So you've got essentially a very, very low risk investment that's producing over 5%, which is great, right? That's great. The maybe detriment is when or if rates are reduced, those money market accounts are going to be the first things that are affected. They're going to go down fairly quickly. So when Derek brought up that pie piece and we have some cash and we've got some money markets and we have some T-bills, one of the things we're doing is going a little bit longer duration on the treasury bills. That doesn't mean they can't be sold. That doesn't mean they can't be liquidated. What we're doing is locking in that interest rate for a little bit longer, so that in case interest rates do go down, we benefit from having a higher rate for a longer period of time. In 2022, when they were raising interest rates, Derek and I were putting clients for this emergency account, we were putting them in 3-month treasury bills because they were paying high rates, and then every 3 months we could roll them into one that paid higher. And that was a fantastic opportunity. We're still doing that. We're still having some shorter duration, but we're also the term is laddering. We're moving some of it to the longer duration so that we can lock up those interest rates for a higher period of time. So that's something if you've got some fixed income exposure, it might be something worth looking at. Derek, did I miss anything on that one?
No, I don't think so. I think you hit everything.
Any questions on that? Well, let me add one more thing. So when we go to that emergency account, if you look at that pie piece, the one thing that jumps out at you is liquidity and safe assets, right? A treasury bill is considered the world's safest asset, right? Because I don't have a counterparty risk. I don't have to have it with a company that needs to stay in business. I'm buying it, and I really need the treasury and the U.S. government to continue on. So because those have the ability to tax and print money, they are considered the world's safest investment. All right, so we are on to, which one am I on, Derek, here? 4.
Calculate your accumulation goal.
Okay. So the big question that I get with clients coming in for the first meeting or they're beginning their plan, Everybody wants to know, how much do I need to have to retire, right? That's an idea that we should have in mind. And a lot of people save and invest without really having that in mind. They just hope it works out. And that's better than not saving and investing, right? But I think we want to have an idea as we're building this, just as if you were building a home before you started nailing studs together, you'd probably want to know what the home's going to look like afterwards, right? So we want to do the same thing with our accumulation. So the CFP board recommends that we have anywhere, if we are saving 11 to 15% of our income and we're working towards normal retirement, 62 to 70, they recommend having, well, I should say they recommend having it after 65 anywhere between 16 to 20 times your income. We typically recommend anywhere between 15 to 18. If we do the math, and I'll show you why that works. So 15 to 18 times your income. What do I mean by that? So let's do a calculation. Let's assume that we have a client and they decide that to make their retirement work, between husband and wife, that they need $100,000 a year to make their retirement work. Using that for nice round numbers. Well, if that's the case, again, we want to lean towards the higher end. I want to have 18 times my income in a perfect world, which would be 1.8 million, right? If I need $100,000 a year, getting to 1.8 million, here's why the math comes in. A typical planner will have a withdrawal rate on the conservative side of 3%. What I mean by that is, so I've got my assets, how much can I safely pull per year and not have to worry about depleting it, running out of money, outliving my money. A typical planner will use a withdrawal rate anywhere from 3 on the conservative side to 5 on the high end. So typically with this, we're going to kind of go lean towards the other side, not super conservative, but we're going to start with a 4% withdrawal. A 4% withdrawal of 1.8 million is $72,000 a year. So what we find with most retirees is they need about 65 to 80% of their working income in order to make their retirement work. Why less? Well, I'm no longer saving 11 to 15% in my 401k or my accumulation plan. I am, maybe my debts have been paid down. Maybe I'm spoiling my grandkids and I'm not having to pay for housing, feeding, and educating my children. So a lot of times the costs have actually gone down in retirement. My obligations have gone out. I'm not actively saving as much anymore. So that 65 to 80% is a typical retirement income need for most people. So we got our investor to 72%. A 4% withdrawal of 1.8 million, which was 18 times his income needs, gets us to 72%. Now, he told us that they needed to be at 100,000. Well, let's not forget, in addition to that, he probably likely paid into Social Security over that time, over his working span. So he's withdrawing a Social Security benefit on top of what he's pulling from his investment assets, which should put him at or above the $100,000 mark, allowing him to have the income he needs. And we've started with a safe withdrawal because as inflation goes up over the years, he's going to have to increase that. The Social Security benefit will get typically every year, get some form of a cost of living adjustment, meaning as inflation goes up, they adjust the benefit they're giving you so that you're getting more money. Not every year, but there are years when inflation is high that they give you that cost of living adjustment. And we want to do the same thing with our retirement withdrawal. So if it's too high in the beginning, we don't have the ability to do that. So the focus should be when we're beginning a retirement strategy is what goal do we need to be at? 15 to 18 times. That tells me once I can construct that. I know my savings rate. I know I need to know where I need to get. Now the other component of that is return. And now we can pick an investment that is appropriate for your return. All right. How am I doing? Any questions? Derek, what'd I miss?
I just wanted to clarify something on the slide. Your example was $100,000 income. On this slide here, we're using the median household income, which is $74,500.
Okay. And that's the same. I guess
Yeah,
the focus
it's
would be on
proportional.
that.
Yeah, it scales up to higher incomes.
All right, Melissa, I'm paying attention to the time here. Looks like I got 10 more minutes here, so I'm going to try and wrap this up. Derek, the next move here, let's plan for some higher taxes. So if I look at the world we live in right now, our nation has made a lot of promises that it likely will have to make adjustments to in order to keep. You can log on to ssa.gov, which is the official Social Security website. And on there, the Social Security Trust Fund is projected to be exhausted by 2037. Now, that doesn't mean it's going away, but it's on course to be exhausted by 2037. The, um, the Medicare Board of Trustees projects that Medicare will have shortfalls prior to that, prior to 2037. So these are the two major benefits that we as Americans count on as we get into retirement age that are underfunded, right? They're underfunded. So the likelihood is if I see that happening, I'm going to plan for higher taxes. I'm also going to plan for reduced benefits. Uh, I don't know what's going to happen. I don't have a crystal ball, but those are two options on the table. They could either reduce the benefits or extend the time before you can claim benefits, or they can tax us, right? In addition to that, just beside those underfunded programs, if I just look at our gross domestic product to our debt ratio, we're at 129%. In 1981, we were at 32%. So we actually have more debt now than we have gross domestic product. Again, we've got obligations, right? So I don't know what taxes are going to be in 20 years, but me personally, as advisor with the clients, I'm planning for taxes to be higher. So how do we do that? Well, we want some component of our plan that is unaffected by tax increases. A common thing that we can do with that is the Roth. There are Roth options, and there has never been easier ways to have a Roth option as an investor. It used to be the Roth IRA, which is great. It's a great tool. We still use it. However, there are income limitations. If I make too much money, I can't contribute to a Roth. Most of you, if you work for an employer who has a 401k plan, most of the plans now allow for a Roth 401k option. So this is fantastic. I can put a decent amount of my savings rate in a vehicle that will never be taxed again. For those of you who have IRAs in place, the one thing that we don't want to do as investors is defer, what I mean, don't take any tax now on every last dollar and then have every dollar taxed in retirement, right? Because we're having it taxed at an unknown tax rate. So a lot of times with clients come in, if they're in their 40s or 50s and they've got most of the money in deferred stuff, well, we will look at opportunities to begin slowly converting those traditional IRAs over to Roth IRAs, because we can do so with minimal tax consequence, and we can create a situation so that in 15 years, 20 years, whenever they retire, a large portion of their assets now, or a significant portion, are in tax-free investments. Because what does that allow me to do? I can now pull levers, right? I've got some money that's going to be taxable. I got some money that can be tax-free. I have the ability to control my tax bracket, what I pay in taxes. For higher income earners, Derek and I talked about safe and secure investments that produce interest. You might want to look at municipal bonds. Municipal bonds have the ability to receive interest that is federally tax-free. And if I'm buying a bond in the state that I live in, it could also potentially be state tax-free. So these are opportunities to get interest without affecting my tax bracket. One of the things that is overlooked is cash value life insurance. And I'm not here to sell you a life insurance policy, but life insurance has been beat up over time because the buildup of the cash value doesn't compare with the stock market. It doesn't. It never will. It's not designed to. It's a safe investment. It will compare to a bond fund. So if I'm looking for safe assets, cash value life insurance is a pretty good deal because I can put money into it. It can grow without being taxed. There's ways I can pull the money out without being taxed. The dividends from a participating whole life policy, as far as the IRS is concerned, are considered return of premium. So I'm not taxed on that. And I've got a death benefit on top of that that I can leverage as well. So three things: Roth options, municipal bonds, cash value life insurance. Those are ways that common people can look to further diversify their tax exposure in their investment plan. All right, let's get on to assess your risk, Derek. All right. So earlier in this presentation, I talked about 2008. 2008 was a grueling year. And actually, 2022 was a grueling year. If you look past the last 25 years, 2022 was the third worst year over that 25-year span. In 2008, the stock market drew down 49%. From December 2021 to October 2022, the stock market drew down 23% over that period of time. So, and you may have remembered it. You may have looked at your retirement statements and said, geez, this is not fun. Over the past decade, I've seen nothing but growing rates in my account. All of a sudden now I've got a 20% loss, 23% loss in my account. I would say this: use today as an opportunity to review your risk tolerance, because what has happened since then? we are at or near all-time highs again with our stock market. So hopefully we've come back, right? Or at least close to where we've been at, assuming that we didn't sell out and panic in the downturn. So now is the time to make a change. If going through 2022 or 2008 caused you to lose sleep, now is the time to make those changes. And the ride that you're going to experience along the way is going to be dictated by the mix of investments. The more stock exposure we have, the more volatile it's going to be. The less stock exposure we have, the less volatile it's going to be. If I can add in other things like bonds and money markets and real estate and gold, other asset classes other than stocks, that tends to smooth out that ride a lot more. That allocation will determine your long-term return, and it's also going to determine the ride that you experience along the way. There's two components to that, Dirk. If you can get to the amount of time it takes to become a millionaire. So this chart here just shows how much you're saving and the rate of return you get, how long it takes you to achieve $1 million. Keep in mind, there is a risk to being too aggressive and there is a risk to being too conservative. So what we try to do is match that return that allows the client to achieve their goals with the minimum amount of risk, not the maximum amount of risk, the minimum amount of risk. If you're an egghead like Derek and myself, you would call that the efficient frontier. You would call that the most return I'm getting for per unit of risk. And one thing that I highly recommend is that you have your advisor or somebody do an analysis, which is called value at risk. What I mean by that is they can look at your statements right now. You don't have to go through a recession. They can look at your statements and say, okay, if we went through recession right now, if 2008 happened again, what am I going to lose in my account? How am I set up to lose? Because if you look at that number and if it makes you sick to your stomach, well, make a change. The time to make a change is now, not during the recession. All right, I'm going to finish on time here with no cost enhancements. These are things you can do to your retirement plan that cost you no money. Should be done every year. I say, hey, we should do this in 2024. You should be doing this every year. The first thing is tax management of your investment accounts. If you have money investments that are outside of an IRA or 401k, it does not have that wrapper around it, which shields it from taxes. That's fine. You have access to all your money, which is great, especially as a business person. I like having access to money. The downfall to that is I'm taxed along the way. I'm taxed for dividends and capital gains. One of the things you can do within the account is a strategy that's called tax loss harvesting. Under the current tax law, we can write off up to $3,000 of loss. So if at the end of the year, if my account has grown by 10%, but I got a couple things in there that didn't do so well maybe I sell those. I realize the loss, and then I offset any income or capital gains in other places. That's something that we do every year. Also pay attention to where your income and dividends are coming from. Real estate investment trusts are fantastic investments. They produce high levels of income, high dividends. By law, Derek, correct me if I'm wrong, by law, they have to distribute 90% of their profits in the form of a dividend to a shareholder. So you get really high streams of income coming from this. The downfall, they're taxed at ordinary income rates. So if I want to own a REIT, it might make sense to hold it in an IRA, not in my taxable account. Second thing we want to do is obviously pay attention to beneficiaries. All your investment accounts should have beneficiaries on them. The last thing we want to do is leave an IRA to my estate. I want to be able to leave it to a family member. The law allows for tax preferential treatment of inheriting that IRA, inheriting that 401k. I can span the tax over years so that I'm not paying that tax bill all at once. So by all means, make sure you've got the correct and correct beneficiaries. It's not an ex-spouse. It's not a brother-in-law who's a Michigan fan. It's somebody that we want this money going to. So my last one would be a review of your estate plan. These documents that we create, our will, our trusts, our living will, our power of attorney, all these things are great and they are important to our plan, but we tend to make them, stuff them in a drawer, forget about them for 15 years. The problem is our life changes. People enter and leave our lives. Our wishes and desires change. So especially with that, every couple of years, we need to be reviewing them to make sure they still reflect what we want to happen to our assets after we pass. That's all I got. If anybody has any questions, I would love to answer them. Otherwise, I really appreciate the opportunity to share those with you.